In this presentation, we will continue on with our corporation comprehensive problem. We're going to be paying monthly expenses. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Information is going to be up to the top. We're going to enter that information in journal entry form in our general journal, post it to the general ledger, then create the trial balance from it. We're going to be recording 3 different expenses that we're going to pay at the same point in time: utilities, phone, and wages. So we'll start with the utilities here. And we can think of these things as kind of similar to our personal bills at the end of the month. We're going to pay these expenses. We're going to actually pay them at this point in time that we are incurring them. First, utilities. So first question, is cash affected? We're going to say yes, cash is affected. It's going down because we're paying something, and cash is a debit balance. We're going to do the opposite thing to it to make it go down, which in this case is a credit. So we're going to credit cash for the $1,300. We're going to debit something. What will that debit be? Utilities expense. So we can see the expense down here for utilities. Now, why is utilities an expense? We might start to just think that every time we do something to utilities, it should be an expense. Whereas when we did insurance, when we paid insurance, we put it into this asset, prepaid insurance. Why is that the case? It's important to remember that there's a reason for that, and the reason is because utilities we usually pay at the same point in time. If we had prepaid it, as we do with insurance, then we would do the same thing. We'd have prepaid utilities. Or later on, we might deal with utilities that is involved in making something, which means we'll have to capitalize it in terms of inventory. In this case, we're assuming, like is normally the case for a service company, is that we're paying the utility bill pretty close to when we actually used the utilities. So that's why we're going to expense it at this point in time. Next, we've got the phone bill. So we've got the phone bill. Once again, is cash affected? We're going to say yes. I'm going to start this with a separate journal entry as if we're paying kind of separate checks for these 3. So these will be 3 different journal entries. And we're going to credit then cash because we're going to pay the phone bill. So once again, we're going to credit cash with another journal entry. And then we're going to debit. What's the debit going to be? Telephone expense. And again, same kind of reasoning there. It's an expense because usually we pay the phone bill monthly. We pay it pretty close to when we actually used the phone service, and therefore expensing at the same time cash is paid. So here's the expense. Then we've got the wages. Same question. Now we're not going to get into payroll taxes and withholdings here. We're just going to talk about wages as if it was the most simplified format of wages. We can get into a comprehensive problem in and of itself on payroll. And we won't do that here. We're just going to say, well, if payroll was as simplified as possible, we didn't have to deal with withholdings and whatnot, then it would be similar to any other kind of expense we would have. Simple journal entry, is cash affected? Yeah, we're going to pay the employees at the end of the time period, whenever we agreed upon. And then the debit's going to go to wages expense. Now this one's a little bit tricky because you might say, well, the employees worked during the time period and they're not going to get paid till the end of the time period, and it could be significant, that difference, meaning we might pay them at the end of the month even though they're working hourly. And we'll have to deal with that. We'll actually do an adjusting entry with payroll and have to deal with that partial time period where we might be paying employees, because it is a significant difference oftentimes. And on a perfectly accrual basis, we should report the payroll when they do the work. So every hour, possibly, we can report it. That would be not worth our time to do that, even though the information would be better. What we're going to do instead is have an adjusting entry at the end. So when we do our adjusting entries, we will see that. Okay, so then if we were to post these to the GL account, then we're going to find the GL accounts. One's going to be cash. Then we're looking for these expenses. They're all going to be down here: the wages expense, the telephone expense, and the utilities expense. It's going to be in the same order on the general ledger. So here is the general ledger. Here's cash. And then the expenses, remember, it's in order: assets, liabilities, equity, revenue, and expenses. So we're going to be way over here: wages expense, utilities expense, and telephone. Now we're going to zoom in on those. So I'm just going to pick those out. Here they are. Here's those GL accounts zoomed in on them. And we're going to post these 3 journal entries to these GL accounts, starting with utilities. So here's utilities. It's a debit. Going to post it here. Utilities goes from 0 up by 1,300 to 1,300. Then we're going to post the cash related to it. So here's the cash. Cash is going to go here, 1,300. Notice this one shouldn't be here yet. We'll see that later. So here we'll keep going though. Telephone expense. Here's telephone expense. Here's the telephone GL. It's going to go from 0 up in the debit direction, 1,100 to 1,100. And then the cash side of that is going to go here. Cash goes from 43,007 down in the credit direction, doing the opposite thing to it. We're in the credit column, 1,100 to 42,006. And we'll see this next time. So here's the wages expense, 5,000. Wages expense 0, going up 5,000 to 5,000. And then the cash here going from 42.6 down 42.6 for this transaction. So here's us posting to the general ledger accounts. And the detailed note, of course, cash having the most activity to it. So this is just a month's worth of activity. If you're dealing with a company that does a lot of transactions, cash, of course, will have a lot of transactions in it. Also note that when you look at cash, it has debits and credits. The debits should win. So that's because that would mean that we have an asset. If the credits ever won, that would mean we'd be overdrawn. We wouldn't really have an asset. It would flip to a liability. We would owe the bank money. We would have overdrawn. The expenses, on the other hand, income statement accounts only go up. They only have debits. So really these only go in one direction, meaning we only pay the employees, they don't pay us. We only pay the utilities company, they don't pay us. We only pay telephone, they don't pay us. The balance sheet account, the permanent accounts like cash, go kind of both ways. We pay cash and we receive cash. So if we looked at the GL then, this is kind of small, but just note that what's being created from the trial balance, this trial balance is being created by the GL. So we need to change the cash account. Is going to be now this 37.6. That's what's changed. This cash account, and you don't have to write all these 37.6. You just probably right here. And then the wages expense is going to be picked up from the GL. Again, you don't have the second one, probably just the 5,000 here that we had. And then the utilities expense, we're going to pick that up. Again, we only have one utilities right there. It's just being carried down as part of the formula for this worksheet. And then the telephone expense is going to be here. Again, yours is probably coming from here. And so we're going to build our trial balance from that. Those are the only accounts that have changed. The rest are being built from the general ledger as well, but they haven't changed since the prior transaction. If we then were to add the debits minus the credits, we will then add up to 0, meaning the debits equal the credits. So if we take a look at what happened here, all of these transactions are very similar in that cash is going down for all of them. That means assets are going down. And all the expenses are going up. And this is where it gets a little bit confusing, because expenses, if you think of them in the context of total equity, they're actually kind of a contra equity account, because equity, all of these accounts mean that credits will win. The negative numbers here, in this case, formatted as negative, credits will win. And the expenses are debits. So they're going to bring down, they're kind of like a contra equity account in that way. In other words, expenses are going to bring down net income, which is going to be revenue minus expenses, the credits of revenue minus the expenses. So these all brought down net income, which is 27,000 minus 5,000 minus 1,003 minus 1,100, 19,600. And this net income, or all of these accounts, are part of total equity, all of equity here. So that means that equity is going down. So the thing that's tricky about that is when you think about expenses, these expenses here went up, which brings net income down. And if net income goes down, total equity follows whatever net income does. So if net income goes down, equity goes down. If net income goes up, equity goes up. On the other hand, it's possible for equity to change without net income changes. So any change in net income, equity will follow in the same direction. But it's possible for equity to change without a change in net income through dividends or through capital investment through the issuance of stock. Now, it's useful every once in a while, again, to go through these and just think about, okay, the accounting equation, if I add up all the assets, assets will equal the liabilities plus the equity. But when you add up the liabilities and equity now, you have to add up the credits, this plus this plus this plus this plus this, minus the debits, minus this, minus this, minus this. So the assets will equal the liabilities plus the equity. But when you look at the equity, you've got kind of these contra equity accounts, these debit balance equity accounts. And you also want to think of it from time to time that the equity, all of equity, again, if I add this plus this plus this minus this minus this minus this, the credits will be winning, and that will equal assets minus liabilities, which is kind of the book value of the company. In other words, if we were to liquidate the company and everything worked out perfectly, we would sell the equipment for $60, we'd get our cash for the prepaid insurance, $12,000, we would sell supplies for $16, get our money here for the $8,000, the receivable. We'd have enough cash then to pay off the liabilities, and what would be left would be equivalent to the equity section. Again, if everything worked out perfectly. So that's going to be you want to just basically consider those things from time to time. For more accounting information and accounting courses, visit our website at accountinginstruction.info.